Hello from Salt Lake City, wrapping up another Institutional Real Estate Inc. wonderful conference. Very, very educational, and I was asked to coordinate and sit down as we wrapped up this conference and specifically talk about real estate debt investing. It is certainly in the asset class and a subset of the real estate asset class. Of course, it's now morphed more so into other allocation buckets like private credit. But here we are today in an ever-challenging world. Investors like pensions and other institutional investors are seeking yield. Things are priced to perfection, cap rates are compressed on the equity side, and the challenge persists. When we have discussions with institutional investors, the quest for that income is basically married against some of the goals for long-term appreciation and income return for real estate equity. Today, what do we know for sure? It's a very uncertain world. The ability to underwrite and to predict where we will be 3 years from today, 4 years from today, 5 years from today, that really requires the ability to have forecasts and predictions. There's been some strays in underwriting. There's been movements to no longer have cap rate expansion and exit cap rate models. There's now significant increases in rent growth that are required to get to these lofty 18 to 20% gross returns that are available and being spoken about today. Coming from the real estate debt perspective, so same asset class, investment in the same types of properties across the US and globally, there's an ever-changing shift, this equilibrium, this risk-return trade-off, general perception of real estate debt, safer in the capital stack, typically, common mezz funds where there's no leverage. They typically can operate in a narrow band of returns. And the common theme for real estate debt, it can be a diversifier within your real estate bucket. It also can be a hedge from the volatility of the total valuation of your real estate equity portfolio. What do we hear a lot from investors today? There's a lot of risk-on themes. The world is not ending. Let's all get back to it. Let's invest. Another major theme that the tide is raising all the boats is the denominator effect. Equity markets just seem to be quite resilient. The Fed is just allowing the world to just continue on, and we're just going to sort of evolve the debt ceiling. But ultimately speaking, investors really know and understand that the risk-return trade-off between equity strategies and debt strategies, they do move around. When you look at all the uncertainties today, and you look at the ability to have strong low double-digit returns in real estate debt and have upwards of 30 to 35% equity cushion to be insulated and protected, it seems to be no longer something that investors are targeting for just what they perceive as a market top. What do we know for sure? Diversification can be your friend, and as well, when you can get low double digits in real estate debt and your pension actuarial returns are 7 or 8 or so %, it certainly could be a great chance to do that. Jumping into the real estate asset class for debt specifically, it is less mature, it is more complex. There's a lot of ways to get to returns. It's where you are in the debt capital stack. It is the potential use of leverage, certainly more on the senior, less so in subordinate positions. And then it gets more complex again, right? And then it's your use of leverage. It's what type, it's how much. Is it match term funded? Is it recourse? Is it mark to market? So, there's some common themes are folks can apply leverage to senior loans. And a simple, straightforward way you can use a warehouse line of credit. It is not necessarily cheap, but it's an effective way to do it. But what everybody knows about leverage is it works for you, but it can work against you. A definitive challenge to warehouse financing is it's mark to market. And when the world stops, somebody can look upon your portfolio and say, well, margin call 4 p.m. today. So other methodologies are selling an A-note so you can create and originate a senior loan and sell off a senior position in your sort of manufacturing mezz. And then another way that is emerging It has the perception of complexity, but on all calculated merits, it's actually definitively better. And that is the series CLO financing approach. This is a scenario where you are applying leverage to a book of senior loans. But the definitive benefits to warehouse financing is it's match term funded, it's not mark to market, and it's sort of being non-recourse to the environment. What it does is it allows you to have cheaper cost of financing, slightly more leverage for the same amount, and then otherwise being insulated from the macro events that are outside the underwriting expertise of originating that senior loan. It is, like I said, less familiar, but over time, more and more people are getting familiar with it. It typically is something that is thriving more in the middle market for real estate debt originators and lenders. And the reason for that is when you create a series CLO, you're taking a basket of loans and then you're basically wrapping them together. It's getting rated. Those bonds are getting sold into the marketplace. So everybody knows, as I mentioned, diversification a bit earlier. What matters here is would you rather buy bonds that had 4 underlying asset loans inside of them or 20? So inherently, when you have smaller, greater count of diversified book, within, inherently you have a better opportunity to get, higher rates, cheaper cost of financing. So, trying to wrap up, the world is uncertain. Diversification is your friend. The debt portion of the real estate is growing. It is becoming more mature. It certainly suffers from a lack of a benchmark or an ubiquitous benchmark that everybody's really, guiding towards. It's evolving certainly more so to no longer be, you're predicting the market top. So everybody knows even open-end funds, if you want out, you might not be able to get out. So think strategically, think long-term, be cognizant of the risk-return trade-offs of debt versus equity. Speak to your colleagues, speak to your consultants, speak to your managers, ask questions, and really be thoughtful about the ability to get higher risk-adjusted returns. Strong component of that return in the form of income, having that equity cushion again, and then dive deeper into how is that manager doing it? Are they originating it? Are they buying some security? If they're doing senior and they're applying leverage, dig into what kind of leverage is it? And there's pros and there's cons. Ask those questions, and by all means, be thoughtful and think long term. And with that, I'll wrap up. But thank you for listening, and take care.